Welcome to New Investor. If you're here, it's because you know that money no longer works as it used to. Perhaps you've heard of cryptocurrencies, stock market investments, or assets that promise to change the game. But before diving into those topics, there's something essential we must understand. How did we get here? In this second video of our series on learning to invest, we will take a deep dive into how the current financial system works. The system of fiat money. We will discuss the risks of living in an economy where money no longer has a tangible backing. And most importantly, why is understanding this crucial for your future as an investor? If you truly want to learn how to invest, you first need to understand the hidden rules of the game. You'll discover how this system, designed to create unlimited debt and money, erodes your purchasing power over time. Opening your eyes to this reality will be your first advantage as a smart investor. Get ready to see money from a new perspective. Welcome to New Investor. Let's begin with fiat money and the illusion of value. For thousands of years, gold had been the cornerstone of money. But suddenly in 1971, everything changed. U.S. President Richard Nixon didn't need lengthy negotiations or public approval to make it happen. In a televised speech, he announced what he called a temporary measure. The U.S. dollar would no longer be convertible to gold. That so-called temporary solution became the new normal. The gold standard was dead, and the world had just entered the era of fiat money. The concept of money changed radically. Before, every bill had tangible backing, a direct connection to the gold stored in the central bank's vaults. Now, money was valuable simply because the government said it was. Its only foundation was trust. At first, most people didn't notice the difference. They continued using their dollars, buying, saving, and trading as always. But without the restriction of gold, governments now had a power they never had before. They could print money without limits. Why did this matter? Because with the ability to create money out of thin air, government spending no longer had natural limits. Previously, a country could only spend what it had in gold. Now, it could simply print more money to pay its debts. In the short term, this seemed like a magical solution. But in the long term, it meant that inflation would become an inevitable problem. The great trick of modern money. To understand how fiat money works, we first need to grasp the big lie that underpins the current financial system. The money we use isn't real in the traditional sense. It's an illusion based on debt. When you go to the bank and deposit $10,000, you might think that money is stored safely in a vault, waiting for you to withdraw it when needed. But that's not how it works. In reality, the bank only keeps a small percentage of that money in reserves. The rest is loaned to others or used for investments. This process is known as fractional reserve banking, a system where banks can lend out more money than they actually have. Let's suppose the bank has $10,000 in deposits and operates with a reserve ratio of 10%. That means it only needs to keep $1,000 in cash while it can loan out the remaining $9,000. But when that loan is granted, the money doesn't disappear. It is deposited into another bank account and loaned out again. Through this cycle, the banking system can create $100,000 or more in virtual money from the original $10,000 deposit. In other words, most money isn't physically printed. It's digitally generated through this process of loans and debt. Today, it's estimated that only 8% of the world's money exists as physical cash. The other, 92%, is digital money created by banks. This raises a troubling question. What would happen if a large number of people suddenly decided to withdraw their money at the same time? The answer is simple: total collapse. Banks simply don't have enough cash to return all deposits at once. That's why when financial crises occur and people panic, governments and central banks intervene to prevent banks from failing, not to protect citizens, but because they know that if trust in the banking system breaks, the entire system collapses. One of the most famous examples of this phenomenon occurred during the Great Depression of 1929. Crowds of people rushed to the banks to withdraw their savings, only to find out too late that their money wasn't there. Thousands of banks failed, and millions of people lost everything they had. Since then, governments have tried to prevent bank runs by insuring deposits and bailing out banks in times of crisis. But the reality is that the risk still exists. The system relies on the idea that most people will never try to withdraw all their money at the same time. If that trust ever breaks on a global scale, the catastrophe would be inevitable. Inflation, a silent enemy. With fiat money and the fractional reserve system in operation, the next inevitable problem was inflation. Imagine you have $1,000 stored in a safe and decide to leave it there for 10 years. You don't spend a cent, you do nothing with that money. But when you open the safe a decade later, you realize that those $1,000 can no longer buy the same things they did before. That is inflation, the loss of purchasing power over time. Before fiat money, inflation occurred at a slow pace, usually caused by an increase in the production of gold or silver. However, with the removal of the gold backing and the ability of governments to print money without restrictions, inflation became a constant problem. Sometimes inflation is controlled and moderate, as seen in developed countries, where it typically stays between 2% and 3% per year. However, when governments abuse money printing, inflation can spiral out of control. Zimbabwe's hyperinflation is an extreme example. In the late 2000s, the government printed so much money that prices doubled every few hours. Inflation reached a point where a 100 trillion Zimbabwean dollar bill wasn't even enough to buy a loaf of bread. Another recent example is Venezuela, where inflation has destroyed the value of money to such an extent that citizens have resorted to using US dollars or even cryptocurrencies like Bitcoin to protect themselves. But although these cases are extreme, inflation affects everyone. If today you can buy 10 kilograms of rice with a certain amount of money, and in 5 years you can only buy 5 kilograms with the same amount, it means you've lost purchasing power without spending a single cent. For most people, inflation is like an invisible leak in their bank account. They don't notice it immediately, but over time, they realize that their salary no longer stretches as far as it used to, that prices have gone up, and that what was once affordable has become expensive. In conclusion, our current financial system is based on fiat money, a system founded on trust and manipulation. Fiat money, in essence, is a system built on trust. If tomorrow the entire world decided that paper money had no value, it would lose its worth instantly. Unlike gold, which is a physical asset with intrinsic value, fiat money only exists because we trust that it will still be accepted tomorrow. But that trust doesn't solely depend on ordinary people. It depends on governments, central banks, and financial institutions that manipulate the economy according to their own interests. So, the inevitable question arises: if fiat money loses value over time and is controlled by the same governments that have repeatedly devalued it, how can we protect ourselves? Every financial crisis, every bank bailout, and every speculative bubble has revealed that fiat money is not a system designed to protect the value of people's labor. Instead, it serves to keep afloat a model where those who control the issuance of money hold absolute power over the economy. Over the decades, money has ceased to be a reliable store of value. Instead, it has become an economic manipulation tool, no longer a fair representation of people's effort and productivity. It can be inflated and devalued according to the needs of the moment. But the problem isn't just that money loses value over time. Its very existence depends on the stability of a debt-based financial system, a system that only functions as long as people trust it. For years, there was no real alternative. There was no different model to store value and conduct transactions without relying on banks and governments. The idea of a currency beyond the control of institutions was merely a fantasy. Until in 2008, in the midst of one of the greatest financial crises in modern history, a proposal appeared in the darkness of an internet forum, a completely new monetary system that did not rely on central banks or governments. A currency whose issuance could not be manipulated and whose value was based on mathematical rules rather than political decisions. This was a direct response to the failures of fiat money, a new form of currency. Its name, Bitcoin. And with that, we've reached the end of this video. I hope you now have a better understanding of how fiat money works and the risks it poses to your purchasing power. But this is just the beginning. In the next video, we'll dive into Bitcoin, the revolution that has changed the rules of the financial game. You'll discover why many call it the money of the future and how it challenges everything we thought we knew about the monetary system. So, don't forget to subscribe to the channel, activate notifications, and leave your comment. See you in the next video here on New Investor. Until next time.